Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Dana Dioria, Co-CIO of Envestnet, as well as Group President of Envestnet Solutions. She joins me to discuss the benefits of personalization at scale in wealth management. Dana, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me, Jill.
All right, you got it. And let's talk about benefits of personalization. What does this allow advisors and wealth managers to do?
I mean, personalization, I think, has a lot of benefits for the typical advisor. First one, if you're not talking to your clients about it, somebody else probably is. So I think, high level, you want to understand that clients are expecting personalization. Stat here, 70% of wealth management clients see highly personalized service as a factor when they decide whether they're going to keep an advisor or they're going to go to a different advisor. So knowing that, your clients are being talked to by somebody about personalization, if it's not you. It's also though, and I think the key piece of what you're seeing in the market now is the at scale part of it. Advisors have been personalizing their service to clients forever, right? They're building them bespoke models, and then they're managing those models over time. But what we're seeing now so much in the marketplace, and what places like Envestnet are proselytizing about, are the scale part, where tech algorithms have now made it possible to deliver these personalized services at much better scale, so that the advisor doesn't have the cost associated with manually managing these bespoke solutions. And that dovetails nicely with the chart you just showed, that clients expect financial wellness on kind of a global scale, right? I mean, think about the world we live in, where your iPhone or your personal smartphone is providing you personalization all the time. You expect that in your financial life too.
And what are some of the ways that advisors can personalize solutions for clients?
Yeah, there's a number of ways that have, kind of gained popularity, and that we're seeing, a heavy influx now. So direct indexing is probably top of that list. So direct indexing can be thought of as ETFs are mutual funds. I would say direct indexing is to SMAs. You're owning all those underlying securities, but you're doing it at pretty low cost. And, it's called direct indexing because a lot of times you're buying the actual index holdings. It doesn't actually have to be indexing. Really, what direct indexing makes available is customization, granular customization of that solution, whether it's an index or an actively managed solution. But we're seeing a lot of interest there. Something like 6% of our SMA assets are in direct indexing portfolios, but closer to 20% of the flows are actually going to direct indexing. So that's a huge one. Another big one I just saw on the slide, tax. At this point, if you're not using an algorithm of some nature to do tax management and your client owns underlying securities, you're probably leaving money on the table for that client, right? It's not, tax management is no longer a once a year or twice a year, hey, I'm going to look at the portfolio and see what I can do for, harvesting losses, or avoiding gains, and probably not putting the client back to their risk tolerance. It's actually very algorithmic. Every time that client account has to get touched, whether it's for fees, to add dollars to the account or to take a withdrawal, all of that should be done in a tax efficient manner. So tax is another huge one. And then, social preferences, right? And you could be anywhere on the political spectrum, but you may have social preferences that you want worked into that portfolio. And this is not, the 10, 15, 20 years ago version where you just kind of cut off certain stocks, limit the universe based on what the client doesn't want in there. The algorithms are much more sophisticated now for allowing you to invest towards social preferences, really very much minimizing tracking error to the overall index.
Yeah, and also, alluding back to this is not your portfolio 15 to 20 years ago, there's also the curation aspect as well, where you're seeing non-traditional assets as part of a way to diversify client assets as well.
You're so right, Jill. Yeah, I mean, the expectation now, and I don't know that I would say the tech is entirely there, but we're definitely marching that way, is that I can combine my traditional and non-traditional assets and still look at that portfolio as an overall total, right? So if I have public market equities and fixed income, whether it's via ETFs or mutual funds or underlying holdings, and then I have, alternatives, right? A hedge fund or private market holdings, or structured notes, maybe annuities, right? Or credit facilities. All of these things should be able to be looked at in kind of a deliberate way. as an overall asset allocation for the portfolio. And I think what you're seeing is more and more in terms of both startups and incumbents kind of building out tech to enable that, so that the advisor has that holistic view of the client's account.
All right, Dana, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.